If you have a checking account and you're over 60, the IRS updated 3 rules this year, and none of them arrived in your mailbox. No letter, no public announcement, just new enforcement guidance included in updated compliance procedures, and most seniors right now don't realize it may apply to them. I'm covering all 3 today. The number you were told to watch that no longer fully protects you, the ordinary banking habit the government may now view as a red flag, and the family transfer that can quietly become taxable income. Stay until the end. The last one is the exposure many seniors already have without realizing it. Hey, I'm Jack, and this is Retire Smart USA. I break down financial and legal information every week that genuinely helps you protect what you've built and make retirement simpler to manage. So if that's valuable to you, go ahead and subscribe so you don't miss what's coming. Here's rule number 1. The number most seniors memorized was $10,000. Stay below it, the thinking went, and you're fine. That understanding is now incomplete. Under the Bank Secrecy Act, any cash transaction over $10,000 in a single business day still requires your bank to submit a currency transaction report with FinCEN. Your name, social security number, date of birth, and the precise time of the transaction submitted within 15 days. You'll never receive a copy. The bank is legally prohibited from informing you. What changed in 2026 is what the IRS monitors below that number. Updated guidance now examines accounts showing consistent deposit patterns under $10,000, particularly from seniors receiving regular benefit payments, family transfers, or retirement distributions. The threshold isn't your protection anymore. The pattern surrounding it is. There's also a second report most seniors don't know exists with no dollar minimum at all, a suspicious activity report, or SAR. A bank can submit one on a $200 transaction. It's identified by compliance software watching behavior, not amounts, and you'll never be informed it happened. Federal law makes it an offense for a bank employee to alert you, up to 5 years in prison. Worth knowing, too, money orders and wire transfers over $3,000 also require the bank to confirm and record your identification under the same law, even though no report is generated at that level. It's a smaller version of the same record, keeping the government already maintains on file. This applies at credit unions exactly as it applies at national banks. There's no exemption for smaller or local institutions. If you've moved your accounts to a credit union believing it operates outside these rules, it doesn't. Every federally insured institution follows the same Bank Secrecy Act requirements, which means the smartest move isn't changing banks. It's understanding what actually generates a report in the first place. That leads into rule number 2, the one that turns an ordinary habit into a federal flag. Consider Diane, 67, a retired county clerk in Albuquerque. For 11 years, she withdrew $800 in cash every 2 weeks for household expenses. After her husband passed, she increased it to $1,000 to handle bills he used to manage. 6 weeks later, her bank's software flagged the account and submitted a SAR. Diane did nothing wrong. She was a widow adjusting her budget, and the system interpreted her consistency as evasion. Diane didn't learn about the SAR until months later, when a routine account review at her bank identified inconsistencies connected to the earlier report, and a compliance officer asked her to explain the change in her withdrawal pattern. She was able to resolve it because she still had old receipts showing the increase matched new bills she'd assumed after her husband's death. But she told me she had no idea until that conversation that anything had ever been submitted on her account at all. That's called structuring. Under Title 31, Section 5324, and it does not require intent. It only requires a pattern that resembles an attempt to stay under the reporting threshold. Regular withdrawals of consistent amounts below $10,000 qualify, regardless of where the money originated or how legitimate it is. If you use cash regularly, the solution is documentation. A simple note each time with the date, amount, and purpose. If you move larger sums between your own accounts, do it in one transfer instead of several smaller ones. Before the last rule, review your last 90 days of transactions. If you see 3 or more deposits between $5,000 and $9,500, write that down. You'll want it for the steps at the end. Now, rule number 3, the one involving money that never felt like income. Your daughter sends $400 through Zelle for groceries. Your son sends $600 through Venmo for a car repair. None of it felt like income, but under updated 1099-K rules, third-party apps like Venmo, PayPal, and Cash App must report cumulative payments to your account once they cross a set threshold in a calendar year. $2,500 for 2025 activity, phasing towards $600. Zelle operates differently since it processes as a direct bank transfer, so it isn't subject to the same reporting rule, but the income itself is still taxable if it's genuinely business-related. When a processor reports those transfers and you don't include them on your return, the IRS computer identifies the mismatch automatically. That letter is called a CP2000, not an audit, but a proposed adjustment with interest attached. Patricia, 71, a retired home health aide in Memphis, received one in March claiming she owed $1,840. She hadn't worked all year. Her 3 adult children had sent her $3,200 total through Venmo for prescriptions, bills, and a new refrigerator. The IRS matched the 1099-K against her return and identified a gap. She had 60 days to respond before it became an automatic assessment. The solution: have family members write "personal gift" in the memo line when they send money and maintain a simple log. Gifts aren't taxable income to you, but you need to be able to demonstrate that's what they were. One more thing most seniors don't realize: the IRS generally has 3 years from the date you filed a return to question it, but that window extends to 6 years if the unreported income exceeds 25% of what you actually claimed. That means a payment app mismatch from 2 or 3 years ago can still appear today, even if no notice ever arrived at the time. If you've been receiving regular family transfers through these apps for years without tracking them, it's worth reviewing your last few years of app history now, not just this year's, so you're not surprised by a notice covering a year you'd already forgotten about. So here's what I want you to do. The exemptions, the breaks, the refunds most seniors already qualify for but never claim. I've gathered them all in one place, state by state, form by form, so you don't waste hours searching through government sites. Everything's organized fast and simple, so any senior can find exactly what applies to them. No matter what state you're in, there's money you may be leaving on the table. It's called the Senior Exemption Playbook. It's in the first pinned comment right below this video. Just tap it once and you'll have everything you need. Now, stay right here because the last rule is the one most seniors are already sitting on without realizing it. And it's the reason I made this entire video. Here's your action plan, and complete these in order. Step 1. Request your free ChexSystems report and review it for flags or closures you weren't aware of. Step 2. For the next 90 days, record every recurring deposit, source, amount, date. If family sends money through an app, get a one-line note from them confirming it's a gift. Step 3. Combine any planned transfers between your own accounts into one move instead of several, with a brief memo describing the purpose. Step 4. Total up every Venmo, Zelle, PayPal, and Cash App payment you've received over the last 12 months. If it exceeds $2,500 and isn't on your last return, organize your documentation now before CP2000 arrives. Step 5. If a CP2000 arrives, respond in writing before the deadline on the notice, usually 60 days from the date printed, not the date you opened it. Include a brief explanation, documentation, and a signed statement. If the proposed amount exceeds $5,000, consult a licensed tax professional first. Step 6. Place a free security freeze on your ChexSystems file if you're not opening new accounts soon. It won't affect existing accounts, but it restricts how your pattern gets shared with screening tools going forward. None of these 3 rules came with a warning. Your bank can't tell you ASAR was submitted. The payment app won't alert you when it reports your family's transfers. That silence is written into the law. Understanding the actual rules and documenting as you go is what prevents a quiet flag from ever becoming a genuine problem.